Neil Dutta is joining us from Renaissance Macro. He's the head of U.S. economics. Neil, good to have you back here. So how do we balance this commentary from Powell with the apparent concern that crept into this reopening trade today?
Well, I mean, I think the Fed still has our back, so to speak. I mean, they're not, as he said today, I mean, he's not even thinking about raising interest rates, right? So I think that's a pretty clear indication of the way the Fed is viewing the world. I mean, basically an extended on-hold policy with the promise to continue to expand its balance sheet, essentially limitlessly. And remember, the Fed has an unlimited ability to expand its balance sheet. So, there's no talk of tapering, none of that. So, I think the Fed's going to be quite accommodative, continue to reinforce the sort of anchoring of the front end of the yield curve. I do think that the Fed's forward guidance was a little bit confusing. I mean, they talk about the weathering recent events and sort of being on track. I mean, those are two different sorts of things, right? I mean, you can weather recent events and be on track, but that still seems a lot sooner than what they're indicating in the dots, right? So I think they're actually buying some time for themselves to get to some kind of a yield cap program where they sort of, target rates essentially at the belly of the curve in maybe 2 to 3 years out, something like that. We'll see how that goes. I mean, there's probably not a consensus on the committee for something like that just yet, but, the fact that they didn't change their forward guidance and simply communicated their interest rate policy through their, through their projections, I think was interesting to me.
So the dot plot clearly says that everyone's in line for this sustained zero rate policy. Some of the other language, just to come back to, I wasn't super clear on when they say at least the current pace, because they had been slowly kind of tapering off the bond purchases over the last couple months. Is that done right now? Did you take that away from the messaging?
No, I think they're going to continue. I mean, one of the reasons why it had been tapering off is because there hasn't been as much demand at some of these auctions, right? I mean, with the overnight repurchase program. So that's one of the reasons why it had been tapering off. But I do think that, what they're basically communicating is that to me, it's a commitment that they're open-ended with respect to, Treasury and Treasury buying. So, I think that'll continue at the pace that they've been on, more or less.
A lot of people are looking at the big move in bonds today and they go, hey, the trade is back on, the momentum is back. Powell was able to surprise again. Are you in agreement with that? Do you think we could go to new low yields, or is that not something that happens without negative interest rate policy or yield curve control? How would we get the bond momentum trade back with as much steam as it had over the last couple of years?
Well, that's a good question. I mean, I think, on the negative interest rates, I mean, you see in the dots that there's no one. I mean, there's no Coach or Lakota moment here, right? I mean, there's no one calling for a negative rate, through 2022 at least. Mm-hmm. That had been something we saw a couple of years back, I believe, but we're not seeing it today. So I think the Fed is very much resistant and reluctant to actually go the negative interest rate route. In terms of what's happening today, I mean, it's difficult to know. I mean, look, I mean, I think broad financial conditions, the equity markets are what get the most attention, right, as you know, Oliver. But, I mean, I think if you look at broad financial conditions, I mean, they're accommodative. They've moved in an easier direction even after the Fed move. I mean, you've seen a little bit of tightening in equities, but, I think the big story is the dollar's lower and interest rates remain low. So I think if the Fed is thinking about broad financial conditions, which is what they've mentioned in their statement today as an example, I think they, 2 out of 3 ain't bad.
Okay, so right now, negative rates aren't on the horizon. Yield curve control possibly. Do we know what that would necessarily mean for the economic impact? I mean, just to kind of wrap that into the general question here, is there anything here that should make market participants feel that this is going to be economically stimulative, or is this more just about setting a backdrop for other policymakers and fiscal and economic pickup to take its own course?
Well, I think the Fed is definitely willing to, the Fed is clearly willing to nudge fiscal policymakers along to do more. If that wasn't obvious, that's been obvious for weeks now. Mm-hmm. But I think that the bigger story is, what is the Fed trying to do? I mean, typically what happens, right, when you get you saw it last week. We had a big jobs beat, right, Oliver? And what happened? You saw a big backup in interest rates.
Yep.
And one of the most persistent features in business cycles with respect to the front end of the yield curve is that the markets typically anticipate the Fed's tightening cycle way too soon, right? So you get this sort of, the Fed's continuing to push back. I mean, you saw this after 2009, 2010. I mean, the markets always thought the tightening cycle was right around the corner, and then the Fed moved to calendar-based guidance, then they moved to the Evans rule where they tied the forward rate to some kind of an economic outcome. The Fed is basically trying to kill that trade. They're trying to kill the opportunities in the front end of the yield curve. They do not want the market to think a rate tightening cycle is around the corner. And if they have to, on the first whiff of some good economic news, the Fed's trying to kill that trade.
Yeah.
And that's what all of this is about. So that's why I think, the fact that they didn't do anything with their forward guidance today, I think is, to me, it's a bit revealing. I think I was personally expecting them to kind of do some kind of version of the Evans rule. They didn't do that. And I think what they're doing is basically buying themselves some time to basically introduce some kind of a calendar-based guidance with yield caps towards the end of the year. And that would basically kill that trade because even if the economic data improves, the front end won't move. So interest rates will remain quite low.
Let's talk about some of the data here, Neil. Your team and you here on the program basically hit it on the nose, what looks to be the economic bottom right now. Today, some fear kind of creeped back in after a couple announcements. We've seen a few flare-ups in Texas, Arizona, a few other places on the viral front. What's your view on the economy right now? Is our rate of improvement over the last 2 months, is it increasing? Is it slowing? I mean, how do we assess that rate of change for our improvement?
I think it depends on what indicator you look at. I mean, for example, we got mortgage purchase application today, and that recovery continues apace. We basically have a V-shaped recovery in housing. It's true that cases are rising, but if you look at the rate of positive infection, I mean that rate has generally been coming down. So it could be sort of a feature of testing, at least in some of these states. Certainly, some are worse than others, right? So I think, even though you've seen some pickup in Florida, that's not anywhere close to the situation you're seeing in a state like Arizona, let's say. But that's neither here nor there. I mean, the question really is, are we going to lock down again? And I think the train has sort of left the station, and people are willing to tolerate some risk coming back. So that's obvious to me now. And I think it depends. I mean, you're seeing slow improvement in things like these mobility numbers, whether it's the Google mobility, the Apple mobility, but even motor gasoline demand. You've seen a steady pickup. Air travel, you continue to see a steady pickup. So people are sort of continuing to dip their toe back in the water. But what it does suggest to me is that wherever the consensus is right now for Q2, it's probably too low. I think the Atlanta Fed's saying nowcast is like minus 50-something%. With what we know about May in terms of jobs growth, just if you assume no productivity and just look at what the aggregate hours work number was, at an annual rate, you probably had like 65% growth annualized in May. So there's no way that these numbers are going to hold. So if May did that, and we've seen continued improvement in some of these alternative indicators, whether it's number of businesses opening or mobility or weekly same-store sales, they all suggest that June is gradually improving. So if we did 2.5 million or so in May, we'll probably do at least that much in June. That would be my baseline expectation. So I do think that sequentially the numbers should look a little better.
The Fed says in their outlook by 2021 we could have inflation getting somewhere maybe back above 1.5% according to their guidance. What we saw from CPI this morning is still muted numbers. What we've seen through all the inflation reads throughout this crisis has been more on the side of deflation. But I thought was interesting from one of the charts you put out today is there's really two obvious places that are getting hit on the prices right now. Everywhere else, it's actually been positive, as you mentioned, in housing. It's really just transportation and apparel. Just as kind of a last thought here, Neil, right now, it's clear that this seems to be a problem. There's going to be a lot of people that are looking at this and they want to buy gold and they want to watch and they're seeing this dollar collapse and they're going, this is it, man. The great American dominance is finally at a close. There's so many people that have been calling for this type of move post QE, and we're definitely in the most extreme version of it so far. So is that any type of a risk that needs to be factored in to an investor strategy over, say, the next 5 years?
With respect to inflation?
Yes.
I mean, I think inflation's a very low risk, at least in the near term. But to me, the inflation story gets stronger the more sustained the support is to the economy, right? So, I would argue that right now this case is looking a little bit weak because, despite what we heard from Mnuchin today, the appetite in Congress to continue to do more seems pretty weak after, in recent weeks. I mean, they haven't really shown as much sense of urgency as they had been in the past. Now, that could just be political posturing, right? So maybe the Republicans want states to open up before they give more fiscal aid. But, after whatever we're going to get in the next month or two, it doesn't look like there's much appetite to do more. So, to me, the inflation stories really get stronger the more fiscal support is provided to the economy. So, that's really what it hinges on. So, I don't think there's going to be a big breakout in inflation. We haven't really done much stimulus yet. All we've really done is just provide a bridge.
Mm-hmm. Okay. Neil, good to catch up, and looking forward to more here. Appreciate the rundown. Post-Fed, Neil Dutta joining us from Renaissance Macro.